Today, we will talk about what is a Federal Housing Administration (FHA) loan. A Federal Housing Administration (FHA) loan is a home mortgage that is insured by the government and issued by a bank or other lender that is approved by the agency. FHA loans require a lower minimum down payment than many conventional loans, and applicants may have lower credit scores than is usually required. The FHA loan is designed to help low to moderate income families attain homeownership. They are particularly popular with first-time homebuyers. If you have a credit score of at least 580, you can borrow up to 96.5% of the value of a home with an FHA loan as of 2022. That means the required down payment is only 3.5%. If your credit score falls between 500 and 579, you can still get an FHA loan as long as you can make a 10% down payment. With FHA loans, the down payment can come from savings, a financial gift from a family member, or a grant for down payment assistance. The FHA doesn't actually lend anyone money for a mortgage. The loan is issued by a bank or other financial institution that is approved by the FHA. The FHA guarantees the loan. That makes it easier to get bank approval since the bank isn't bearing the default risk. Some people refer to it as an FHA-insured loan for that reason. U.S. Department of Housing and Urban Development. Let FHA loans help you. Borrowers who qualify for an FHA loan are required to purchase mortgage insurance, with the premium payments going to the FHA. Congress created the FHA in 1934 during the Great Depression. At that time, the housing industry was in trouble. Default and foreclosure rates had skyrocketed. 50% down payments were commonly required, and the mortgage terms were impossible for ordinary wage earners to meet. As a result, the U.S. was primarily a nation of renters, and only 1 in 10 households owned their homes. The government created the FHA to reduce the risk to lenders and make it easier for borrowers to qualify for home loans. The homeownership rate in the U.S. steadily climbed, reaching an all-time high of 69.2% in 2004, according to research from the Federal Reserve Bank of St. Louis. In the first quarter of 2022, the rate stood at 65.4%. Types of FHA loans. In addition to traditional mortgages, the FHA offers several other home loan types. Home Equity Conversion Mortgage, HECM. This is a reverse mortgage program that helps seniors ages 62 and older convert the equity in their homes to cash while retaining the home's title. The homeowner can withdraw the funds in a fixed monthly amount, a line of credit, or a combination of both. FHA 203 Improvement Loan. This loan factors the cost of certain repairs and renovations into the amount borrowed. It's great for those willing to buy a fixer-upper and put some sweat equity into their home. FHA Energy Efficient Mortgage. This program is similar to the FHA 203 Improvement Loan Program, but it's focused on upgrades that can lower your utility bills, such as new insulation or solar or wind energy systems. Section 245 loan. This program works for borrowers who expect their incomes to increase. The Graduated Payment Mortgage DPM starts with lower monthly payments that gradually increase over time. The Growing Equity Mortgage GM has scheduled increases in monthly principal payments. Both promise shorter loan terms. What are FHA loan requirements? Your lender will evaluate your qualifications for an FHA loan as it would any mortgage applicant, starting with a check to see that you have a valid Social Security number, reside lawfully in the U.S., and are of legal age according to your state laws. FHA loan criteria are less rigid in some ways than a bank's loan criteria. However, there are some more stringent requirements. Whether or not it's an FHA guaranteed loan, your financial history will be examined when you apply for a mortgage. Credit scores and down payments. FHA loans are available to individuals with credit scores as low as 500. That is within the very bad range for a FICO score. If your credit score is between 500 and 579, you may be able to secure an FHA loan, assuming you can afford a down payment of 10%. Meanwhile, if your credit score is 580 or higher, you can get an FHA loan with a down payment of as little as 3.5%. By comparison, applicants typically need a credit score of at least 620 in order to qualify for a conventional mortgage. The down payment required by banks varies between 3% and 20%, depending on how eager they are to lend money at the time you apply. History of honoring debts. A lender will look at your work history for the past 2 years, as well as your payment history for bills such as utility and rent payments. People who fall behind on federal student loan payments or income tax payments will be rejected unless they agree to a satisfactory repayment plan. A history of bankruptcy or foreclosure may prove problematic too. Typically, to qualify for an FHA loan or any type of mortgage, at least 2 or 3 years must have passed since the borrower experienced bankruptcy or foreclosure. However, exceptions can be made if the borrower demonstrates having worked to reestablish good credit and get their financial affairs in order. Proof of steady employment. Mortgages must be repaid, and the FHA-approved lender will want assurances that the applicant can achieve this. The key to determining if the borrower can make good on their commitment is evidence of recent and steady employment. This can be documented by tax returns and a current year-to-date balance sheet and profit and loss statement. If you've been self-employed for less than 2 years, but more than 1 year, you may still qualify if you have a solid work and income history in the same or a related occupation for the 2 years before becoming self-employed. Sufficient income. Your mortgage payment, HOA fees, property taxes, mortgage insurance, and homeowner's insurance should be less than 31% of your gross income. Banks call this the front-end ratio. Meanwhile, your back-end ratio, which consists of your mortgage payment and all other monthly consumer debts, should be less than 43% of your gross income. FHA mortgage insurance premiums, MIPs. An FHA loan requires that you pay 2 types of mortgage insurance premiums, MIPs, an upfront MIP and an annual MIP, which is paid monthly. In 2022, the upfront MIP is equal to 1.75% of the base loan amount. You can either pay the upfront MIP at the time of closing, or it can be rolled into the loan. For example, if you're issued a home loan for $350,000, you'll pay an upfront MIP of 1.75% x $350,000 equals $6,125. These payments are deposited into an escrow account that the U.S. Treasury Department manages. Despite its name, borrowers make annual MIP payments every month, with the payments ranging from 0.45% to 1.05% of the base loan amount. The payment amounts differ depending on the loan amount, the length of the loan, and the original loan-to-value (LTV) ratio. Let's assume you have an annual MIP of 0.85%. In that case, a $350,000 loan would result in annual MIP payments of 0.85% x $350,000 equals $2,975, or $247.92 monthly. These monthly premiums are paid in addition to the one-time upfront MIP payment. You will make annual MIP payments for either 11 years or the life of the loan, depending on the length of the loan and the LTV. Before you go, please hit the like button and subscribe to my channel.